Today we're going to go on to a bit of an advanced topic. We're talking about how implied volatility affects option prices and how you can manipulate the crowd by taking contrarian positions to what the crowd is doing. Today I was looking at Cisco. Like on a routine basis, I'll go to the internet, I'll look up biggest percentage gainers or highly active stocks or highly traded stocks, just things that the general public know about. And if you've been watching CNBC at all, they say something about Cisco nearly every other day. It's basically pathetic. But let's see, we're trying to play off the irrationality of crowds. So let's take a look here. I'm going to get rid of this study. I'm going to get rid of the volume pane because that really doesn't matter. Let's see. There we go. All we really care about is this right here, and I'll actually make that even thicker so we can get an idea of what it actually looks like. And then this one. Alright, what we're looking at right here is the blue line and the black line. Blue line is historical volatility, and the black line is the average implied volatility. Now, the difference between historical and implied volatility. First, implied volatility is what is being inputted into the option prices. So they're saying that it's implied that because options are expensive, that the volatility is high. Therefore, when the implied volatility is low, options are cheaper. Now I'm going to repeat that one more time because this is essential to know. When implied volatility is high, options are expensive. When implied volatility is low, options are cheap. That means when it's high, we would rather be selling options to the public. When it is low, we would rather be buying options. Now, next one's historical volatility. Historical volatility is an actual volatility measurement, while implied volatility is just what the marketplace is believing. Historical volatility basically measures, in a sense, the standard deviation. This is just one method. The standard deviation of a stock over a period of time. Here, you can actually take a look here. The blue line is historical volatility here. And we're looking at a 20-day moving average of the historical volatility. What happens on this day, right here? We have an earnings announcement. Cisco drops over 15%. What happens? Historical volatility skyrockets because we have these little days, 1% move, 1%, maybe a 2% move on one day, and then suddenly over 15%, nearly 20% drop in one day. Historical volatility goes straight through the roof. Now, what we can do to manipulate people, I'm going to say it as it is. Let's say I want to trade an option and it's going to expire in 3 months. Go to the 3-month chart and take a look at the volatility. Now, something that has proved useful to me is that implied volatility very rarely goes above historical volatility. Well, it rarely goes above the peaks in historical volatility. So, for instance, like we went back to the 6-month chart here. It only for about a day, implied volatility got above the historical volatility. And I'm talking extreme peaks, like even go back to a year. Implied volatility never got that high. But if we go back to 2 years, back in 2010, implied volatility was going very high. Anyway, so 3-month chart. We take a look at this and we say, all right, in the range right now between, for the volatility is between, let's see, 31% for the implied, which is on this right side here, the right side scale, and historical, anywhere between 15 and 25. So we're going to say, all right, we had low volatility for a while, then volatility went up, nearly hit a historical volatility peak just at the same point, went down, and now it's going back up. Historical volatility already peaked, so we can basically say we're in a high volatility situation right now. So what do we want to do? We want to sell options. Now let's take a look at the price. What's going on with Cisco? We pretty much have a slow downtrend, plain and simple. So we're going to go to our Analyze tab in Thinkorswim, take a look at we're going to simulate a couple positions. I'm going to get rid of these here. And I'm going to get rid of that. And I really want you to be keeping an eye on this right here, theoretical price. The lowest point of volatility in the last few months was around 25. Now it's sitting at about 31. What happens if I, let's say I want to sell this call August at a 16 strike price. It's 30 cents for the option, and the theoretical price is 31 cents. What happens if we go back down to that low volatility situation where it was about 6% less than it was today? All else equal, the option would be worth 33% less. I just wanted to show you that, just to show you how much of an impact volatility has on the actual price of an option. So a very small move in volatility can wildly affect the price of an option. So in this case of a situation, what am I doing? We're in a high volatility situation. The market seems to be having somewhat of a bottom. It's kind of fumbling around right now. And Cisco's next earnings announcement, which seems to be, they always make big moves when there's an earning announcement, so we would get out of position then, is in mid-August. So what are we going to do? Well, this is what I'm going to do. And I'm not keeping track of this on the website because I don't have enough experience with options trading yet to be that sure of myself. We're going to, well, actually, this is what I was planning on doing. I'll actually bring this one up here. I was going to sell the August calls at 17 for 13 cents, and I was going to sell the August puts at 13. No, the August, the August calls at 17, the August puts at 13, and I'd get a $28 credit. So that, all I'm saying is we're taking advantage of the volatile situation. We're going basically neutral as long as until August the price of Cisco stays between $17 and $13, we make money. Now to do probabilities on this, we can open this up, which gives us a probability model. We say, alright, what is the probability of us breaking even? And actually, just for simplicity, I'll say, what's the probability of Cisco being between 13 and 17 on the options expiration date? 67.75%. Now we do have to adjust because we're selling these options. We're getting paid to do it. So we take our 28-cent credit applied to each side, and our true break-even chance is actually 74.12%, which, hey, I'll take that. And what do we do now? the way that I manage this, if the price ever touches your strike price, so if it touches 13, I get out. If it touches 17, I get out. But the nice thing about this trade, say the stock really doesn't do much, and then suddenly in mid-July the stock goes wild. We'll just say a month from now. No, we'll say 2 weeks from now. July 11th, the stock price starts moving, and it moves to like 14 bucks, and we're saying, what's going on here? Don't worry about it. We're at break even right now. Say we go out a month from today, July 27th. The stock is it's moving down to $13 at that time. We have a $145 loss on it. Well, $145 on 7 options. Say we only traded 1. We have a $20 loss. We can take that. Now what happens, say, if volatility goes down? If volatility goes down, that means the option is going to be worth even less. So even though the trade might be going against us, we might still exit with a gain. So it's these kinds of situations that we want to be looking for, because they are very favorable when they do occur. So bottom line, when option volatility is high, near the peak of its recent historical volatility, which was around the 31, 32 level, when it's around that area, we want to sell options. When volatility is low, say back in May, like the 23rd, we want to buy options. It's nice having these positions available for us, because we don't need to necessarily guess which way the market's going to go to actually make money, because we have volatility on our side. Alright, I know this was an advanced topic. If you got any questions, post in the comment box. Please, please, please. Hope I didn't make your eyes glaze over. And thank you for watching.